What if I told you that there's an account sitting out there that grows your money completely tax-free, lets you pull it out of retirement without paying a single dollar in taxes, and has a deadline coming up in 1 week that most people are going to miss without even realizing it? That account is the Roth IRA. And today we're going to cover everything you need to know. What the limits are, who qualifies, why you don't have to come up with a big sum of money all at once, and exactly how much money you could be walking away from if you don't take this seriously. Welcome back to Compounding with Callie, where we compound some miles and our money. So let's start with the deadline, because this is urgent. The IRS gives you until April 15th, 2026 to make contributions to your Roth IRA that count for the 2025 tax year. That means, right now, today, you still have a window to go back and fully fund last year's account. But that window is closing fast. And here's something a lot of people don't realize. If you miss the April 15th deadline, that's it. You cannot go back. You cannot make up for the following year. The contribution limit for 2025 is a use it or lose it deal. Once that deadline passes, whatever you didn't contribute is just gone. That tax-free growth opportunity disappears forever. And that's not a small thing, because the money you put into a Roth IRA doesn't just sit there. It compounds. Every year that passes without a full contribution isn't just a missed deposit. It's decades of tax-free growth on money you've never put in. So if you haven't maxed out your Roth IRA yet in 2025, you have a few days to fix that. Keep watching, because by the end of this video, you'll know exactly how to do it. Now let's talk about the actual numbers, how much you can put in, and whether you're even eligible. For the 2025 tax year, the Roth IRA contribution limit is $7,000 if you're under 50 years old. If you're 50 or older, you get an extra $1,000 catch-up contribution, bringing your total to $8,000. For 2026, those limits go up slightly. $7,500 for under 50 and $8,600 with a catch-up fee for those 50 years and older. The IRS adjusts these for inflation periodically, so it's always worth double-checking the current year's numbers. Now, and this is important, not everyone can contribute to a Roth IRA. There are income limits, and they're based on your modified adjusted gross income, which for most people is pretty close to what you see on your W-2. For 2026, if you're a single filer earning under $153,000, you can contribute the full amount. Between $153,000 and $168,000, your contribution limit starts to phase out. Anything above $168,000, you're no longer eligible to contribute directly to the Roth IRA. And for married couples filing jointly, the full contribution is available below $236,000. It phases out between $236,000 and $252,000, and it cuts off entirely above $252,000. If you are above those thresholds, there are still strategies available, like what's called a backdoor Roth IRA conversion. But that's a topic for its own video. For the majority of people watching this, if you have earned income and you're under those limits, you're good to go. Okay, so now that you know the limits, let's talk about the part that trips most people up. How do you actually come up with the money? For a lot of beginners, hearing $7,000 feels like a wall. They think they need to find a lump sum all at once. They don't have it sitting around, and so they don't contribute at all. And that's the worst possible outcome, because there's a much easier way to handle this. Instead of scrambling for a lump sum at the end of the year, or worse, scrambling in April when the deadline is hitting, the move is to break it down into monthly contributions and automate it. $7,000 a year divided by 12 months is about $583 per month. For 2026, at the $7,500 limit, you're looking at $625 per month. Set it up on the first of every month automatically, and you'll never have to think about it again. Here's why this matters beyond just convenience. When you contribute monthly instead of annually, your dollar cost averaging into the market throughout the entire year, buying at different prices at different times, which smooths out volatility and removes the temptations to try to time when you make your deposit. You're also getting more time in the market. Money sitting in your checking account waiting for you to make a lump sum contribution in December isn't growing. Money invested in January is compounding for 11 extra months that year. Over 30 years, those extra months of compounding add up to a genuinely meaningful difference. And if $583 a month feels tight right now, start somewhere. $200 a month, $300, you can always increase it later as your income grows. The worst version is contributing nothing because you couldn't do it perfectly. Some is always better than none. And building the habit is the hardest part. Once it's automated, it just happens. Before we get into the numbers, There's one thing that tripped up a shocking number of first-time Roth IRA owners, and it's important enough to call it out directly. A Roth IRA is not an investment. It's a container. Think of it like a special tax-protected bucket that the government lets you put money into. But the bucket itself doesn't do anything. What you put inside the bucket, that's what grows. When you open up a Roth IRA and deposit money into it, that money by default usually just sits in cash inside the account, earning almost nothing, while you think it's working for you. A lot of people open up a Roth IRA, feel good about it, contribute for a few years, and then look back one day at their balance and wonder why it's barely moved. It's because they never actually invested the money inside of it. Once your money is inside the Roth IRA, you have to go in and manually choose what to invest in. For most beginners, a simple broad market index fund, something that tracks the entire S&P 500 or maybe the total US stock market, is all you need. One fund. Set it up, automate future contributions to go in at the same fund, and you're done. But that step cannot be skipped. Deposit the money, then invest it. Those are two separate actions, and both have to happen for your Roth IRA to actually grow over time. Now let's make this real with some actual numbers, because this is where the Roth IRA goes from sounding good in theory to being generally jaw-dropping. Let's look at two different people. We'll call them Investor A and Investor B. Both earn the same income. Both max out their Roth IRA at $7,000 per year, invested in the same broad market index fund, earning 9% annually. A reasonable long-term estimate, slightly below the S&P 500's historical average. The only difference between them is when they start. Investor A starts at 25 years old. They set up automatic monthly contributions, invest the money inside their account into an index fund, and never touch it for 40 years. They retire at 65. However, Investor B waits. Maybe life got in the way, maybe they kept telling themselves they start next year, whatever the reason, they don't open and fully fund their Roth IRA until they're 35. They contribute the same $7,000 per year in the same index fund at the same 9% return. But they only have 30 years until retirement instead of 40. And here's what that 10-year head start is actually worth. Investor A, 40 years of maxing out at $7,000 per year, ends up with approximately $2.4 million in their Roth IRA. Over $2 million, and every single cent comes out completely tax-free in retirement. No income tax, no capital gains tax, the government gets nothing. They contributed a total of $280,000 over 40 years, and the account grew to over $2 million. That's over $2 million in pure tax-free growth on top of what they put in. Investor B, same contributions, same return, but starting 10 years later, ends up with approximately $954,000. Still nearly $1 million, which is generally impressive. But look at the gap. Investor A ends up with $1.4 million more than Investor B, despite contributing over only $70,000 more in total. That extra $70,000 contributions started a decade earlier, compounded into an additional $1.4 million in tax-free wealth. That is the power of time in the market, and that is exactly what you're giving up every year you wait. The lesson isn't complicated. It isn't about being smarter or earning more. It's simply about starting sooner. 10 years of waiting doesn't cost you 10 years of growth. Because of how compounding works, those first 10 years are actually the most valuable ones. The early contributions have the longest runway to multiply. Investor A's 25-year-old self made contributions that add 40 years to compound. Investor B's contributions never got that chance. So here's where we land. The 2025 Roth IRA deadline is April 15th, 2026. If you haven't maxed out your contributions yet, you still have time, but not that much. The limit is $7,000 if you're under 50 and $8,000 if you're 50 or older. And you need to be under the income thresholds we covered to contribute directly. If you're already past the deadline for 2025, then the most important thing you can do right now is set up automatic monthly contributions for 2026 so you never see yourself scrambling at the deadline again. $625 a month, automated, into a Roth IRA invested in a broad Martex index fund. Do that consistently for 40 years, starting in your mid-20s, and you'll be looking at over $2 million in completely tax-free retirement wealth. The Roth IRA is one of the most powerful financial tools available to regular people. The limit is not that high. The barrier to entry is low, and the reward, decades of tax-free compounding, is extraordinary. Don't leave it sitting on the table. If this video helped you, drop a comment whether you're going to fund your 2025 Roth IRA before the deadline. I'd love to know. And make sure you're subscribed because we got a lot more coming. Thanks for tuning in. Same pace next time. Keep compounding.